name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be your host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is dedicated to the topic of profit taking. In a previous webinar on stop placement, I've shared my view on managing losing trades. But eventually we earn money when we exit a trade with a profit. So in this webinar, I will focus on profit taking, which is now a less important topic than stop placement. Most of ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups. Now we are ready to start. And before we start, let's take a quick look at the disclaimer. Please be aware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. And first of all, I want to say that taking your profit is not a science. You just can't be told by someone that you should do certain steps to fix your profit correctly. And after all, there is no right or wrong in the market. Well, first of all, of course, you have to have a profit. We assume that you are having a profitable position. Only after that, you can decide whether you want to take this profit from the market or whether you want to let this profit run. And as I have said, there is no right or wrong in the market, but nevertheless there are several key principles that might help you to set more adequate targets and exit a trade before price reverses and you give back to the market most of your paper profits. By paper profit we mean profit that is not fixed yet. So there are several principles. First of all, you can take your profits using average daily range or daily volatility, or you can employ logics of the measured move, or you can use sometimes harmonic patterns or harmonic numbers. Then you can observe price action, and finally you can use a trailing stop when you decide not to take your profit and when you decide to let your profit run. And let's start with the first idea, which is based on average daily range. The idea beyond this method is that you don't try to understand the market. You just measure average statistical deviation of the price and assume that market will experience difficulties in sustaining the move once it overcomes the average deviation. First, you have to measure average size of the daily bar or a candlestick. I want to stress one more time that we take daily bars. It is not a method for 30-minute or 5-minute bars. Principle can be pretty much the same for different time frames, but in the context of this webinar we are talking about daily bars. Then, if you enter a long position, you see how many pips were already completed in the context of the suggested move. For example, if average size of the daily bar is 100 pips and your location for entry is 50 pips higher than the suggested low of the bar, you have more 50 pips before the market will possibly reach the resistance or reach the suggested high of the day. And you can set your take profit order at the suggested price, taking your profits out of the market. Of course, price action can be updated for the very next day, but if you hold your position overnight, you automatically accept risks of higher time frames, so you can't afford tight stops or tight trailing stops in this case. And if you trade within a day, you are about to make a decision where to exit your position within this day, so it can be a reliable price calculated from the historical data. Of course, when we are talking about average daily range, we assume that we don't know the exact volatility of the bar, so it is an assumption. Of course, price action can be updated much higher than our suggested price. In this case, we can have a trending day. Trending days are very different from average days because they can generate 150 or 200 pips in just one day, when price action starts to go from the beginning of the day and it ends only as the day closes. So trending days fall out from average statistical numbers. Now let's talk about methodology. To measure average size of the bar, you can use average true range indicator, or ATR. You are familiar with accumulated for the period of 3 days. But if market is going to the upside, is breaking out to the upside, I get very good profit loss ratio and my trading account starts growing very rapidly. Now let's talk about technical analysis and switch to technical analysis from statistical studies. Technical analysis is absolutely not a science, and every trader has a unique perspective on what is happening in the marketplace. And another method of placing take profit orders is employing the old principle that nevertheless remains still relevant for today's trading as well. It is principle of a measured move. AB equal to CD means that most of the time market tends to generate symmetry between legs of any trending move. If you remember any pattern, any chart pattern like triangle or flag or pennant, which are patterns of continuation, you might remember that the principle is pretty much the same for such patterns. You see the pattern, you measure the move that preceded this pattern, and then you just project this move to the next leg, and you set your take profit order using these dynamics. In reality, it is not so easy to find classical patterns mentioned above, but we still can use this principle for rotational centers that we have discussed in previous webinars so far. If we identify rotational center, it can serve as a starting point for the second leg. It's very important to know where the second leg is going to start. Rotational center in this case will serve as a starting point. On this slide you see daily chart of American dollar versus Canadian dollar, and rotational center here possibly falls into the spot of low volatility. And it shows us the starting point for the second leg of the move. First leg, or AB, is considered to be built this way, and CD leg is considered to be built like it is shown here. So you see that AB is equal to CD or almost equal to CD leg here. Okay, I want to show you one more example from 30-minute chart of Australian dollar versus Japanese yen. And rotational center here is possibly located at level 88.65, which I show you by the red line. This is a level of reduced volatility. If you see at the previous dynamics of this currency pair, you see that this level shows reduced volatility. Market sort of consolidates around this level. Then again you see pullbacks, reduced volatility again. And finally, the initiative which starts from this level is going to be the second leg, the leg CD. So how are we going to measure our target in this case? We can build a symmetrical or measured move here. So here is a rotational center. Let's mark it with letters RT. Then once market starts to go away from this level, we build a measured move and estimate our projected target. Projected target will be located here. You see this is a pretty accurate point. After reaching this point, market reverses, but not every time market is going to reverse. It is just this example, but this example shows pretty accurately how the measured move actually works in a real time. So you see, this is pretty good trade. And another interesting example is from New Zealand dollar.